Got me? Hello, everybody. We're still a little bit early. Can you hear me all right? There we go. I see the microphone working. Well, happy spring, right? Didn't it start to be spring here just a few days ago? Almost looked like it today with my winter coat on and raining a little bit this morning, but some of you are across the country, so I'm sure we have it better than a lot. But again, welcome to the Financial Forum. I'm Jerry Slusowitz, your host. This is interactive. I know people will be just joining us, so I'm kind of delaying here, but little ground rules is at the bottom of your screen. If you move your mouse down there, there's either Q&A or chat, and you can go down there and put in a question, and I will answer your question. Now, we're going to go through this stuff kind of sequentially, so if it's something I'm getting to, I'll answer it. Otherwise, what I'll do is I'll just take your question as it comes up, and I will read the question or say the question out loud for everyone else to see and hear. So it's not like anyone's going to lose out. And as I said, down at the bottom, either Q&A or chat, and just type it on in, and I'll try to get to it as quickly as possible. So again, this is the reducing taxes, a strategy for success in retirement. A lot of people want to pick the next winner, the next Tesla, the next Google when it came out, or a number of these stocks, Microsoft way back in the day, and they're looking for that to make money, or the best mutual fund, or whatever it is. And one of the best consistent strategies for investment success is paying your fair share of taxes and not a penny more. And so if there's tax advantaged ways to invest, or tax free or tax deferred ways, we're going to talk about the three types of taxes here in a little bit, it's better. Will Rogers said, the only difference between death and taxes is that death doesn't get any worse every time Congress meets. And so this tax thing is a constantly evolving and changing thing, with a lot of proposals out there that promise to not hurt some people, but there's always unintended consequences when more people get hurt than what they thought. So we're going to give you some methods to protect your nest egg and increase your returns by limiting the amount you pay in taxes, which is something you can do every single year. And so I want to kind of get into the tax planning versus tax preparing. Because right now, here we are, March 2023, and a lot of you are doing your taxes. And this hint won't necessarily help you for last year, unless you were eligible to do a qualified IRA or Roth IRA, because you had earnings of up to $7,000 last year. You could still do that before April 15th, or I think maybe it's April 17th this year. But pretty much everything that happens in the calendar year between January 1st and December 31st, that's history. And that's what a tax preparer does, is they look back at your history and they see what happened in 2022 that you're working on here in early 23, and you're reporting it. Now, your tax preparer can hopefully come up with strategic ways to show what happened that might make it more advantageous in the way you fill out your 1040 forms and all your other Schedule A's through D, etc., where a tax planner like myself is a forward-looking strategy. So I don't prepare taxes. I have my own CPA that does my taxes. But what I do is I help people come up with strategies so that whatever you paid tax on in 2022, maybe we could reduce that in many different ways with some of these strategies we're going to cover today, and not have to pay as much in income taxes next year in 24 when you're preparing to see what happened in 23. And some of these strategies will last going forward. So it's a hot topic. Right when I picked this topic, right afterward, this is March of 2023, the latest issue of my investment news. Hopefully you guys can see this, but it's a milk carton, how they have missing children on the milk carton. So it's tax cuts, best if used before December 31st, 2025. And what they're talking about here is the Tax and Job Act, sometimes known as the Trump tax plan. That was a 7-year plan passed in 2018 that is going away in 2025. Well, we're already in 23, so you got 23, 24, 25. In 3 years, that Tax and Job Act is supposed to revert back to the old way that taxes were done. So how many of you, by show of hands, think that taxes are going to go down in 2026? Well, since I can't see anybody, I see no hands raised. So therefore, I'm going to assume that everybody's like me that believes taxes are going to go up, not down. And therefore, these tax brackets, oh, someone sent me a flying thumb. You guys much better than me. I don't know how to do the technology stuff. You see me suffering to get through these webinars. So if it wasn't for Nancy helping me, I'd be lost. So the bottom line is that these tax cuts. Now, I know a lot of you went, oh goodness, that's a real problem. I actually had to pay more taxes. One of the things that came out of the Trump tax plan was he punished high tax states. So for those of you in California, your state and local taxes, what they call SALT tax. Hey, Doreen, there's no audio, but you can type it in and I'll read your question on the chat. And same thing, you use Q&A. If you have questions, just go ahead and type them in and I'll get it. But no, not everyone, you can't all hear each other. It'd be just mayhem. So I shut everyone down. You can't speak. You can type though, and I'll read it. The point is that the state and local taxes are capped at 10,000. Well, guess what? California, not all of you are in California on this webinar, but California is a high tax state. And then guess what else? Because our home values are so high, not that our property tax value is high, but it's based on the home value. If you bought a home for $1 million and it's 1.1%, that's $11,000 of property taxes. That gets thrown in with your state income tax. Let's say that was 10,000. And then if you have local taxes, some cities have local taxes as well. You're capped at 10 grand and you might have $25,000, $30,000 worth of state and property taxes, et cetera, that you can't take advantage of. So some of you might be going, well, when the Tax and Job Act, reverts back, you'll be happy. But for most Americans, they actually did benefit because the tax brackets are as low as they've ever been. Remember, your first $10,000 worth of income, doesn't matter how much money you make $1 million a year, your first 10,000 is taxed at 10%, and that's your adjusted gross income. And then, and that's if you're single. If you're a married couple, you're at 19.9 or something like that. So the tax brackets are like a wedding cake, and they go higher and higher. With us being $32 trillion in debt, okay, which is where we are, and in the next 3 years, I don't see the debt going down. I see it going higher. I see no one making any attempt, and I'm talking about both administrations. As you guys know, I try to not be political. Sometimes it sounds like I'm bashing one side or another. I'm bashing policy that I think is not intelligent when it comes to investments. And so I can't see rates going down. So we only have a few years left of these lower income tax brackets before you're going to be probably launched into a higher tax bracket. Again, I doubt if many people think taxes are going to go down. So tax planning, tax preparation, and then taxes going higher. That's really important. So where you put your money matters. All right. And so what I've done here is this is available to everybody. You can just call in the 949-219-0692. That's our office number, 949-219-0692. You think I'd have that somewhere on the screen, but or email us info@PFP, Pacific Financial Planners, PFP for Pacific Financial Planners, and then the word invest, invest.com. So info@pfpinvest.com or the 949-219-0692. And hopefully you guys can see this, but it is it's a brochure that I have in hard copy. I mean, here, just to get that off, just to show you. See, I have this. We'll mail you this, either hard copy or we can electronically email it to you, and you'll be able to see some of the materials that I'm going through. But that's, where you put your money matters. Are you paying too much in taxes and then in retirement? Because a lot of people aren't aware that when you reach retirement age, so some of you might have retired early, 52, 55, and between that age, and some of you retired at 65, 67, or 70. But between whenever it is that you choose to stop getting a paycheck from an employer and when you start taking your required minimum distributions, in that time frame, I guess I'm going slow here. In that time frame between when you retire and when you have to start taking your RMD, you have more control over taxes than at probably any other point in your life, other than maybe when you were young and didn't make much money and didn't have to pay much taxes. But in your adult, earnings year life, you have that control. Don't abdicate that time. If you're already over 73 and older, where you're stuck with the RMDs, some of this stuff isn't going to apply to you, but some of it still does. Believe me, it's very comprehensive what we're going to talk about today. But for those of you prior to that, you want to get a retirement income analysis. I can't stress that enough. We talk about the 3 types of taxes. I talked about what tax planning versus tax preparation, why this isn't what your CPA does. You can really take advantage. Now, I was just in U.S. News and World Report. I should have had that up as well this week on ways to reduce income taxes, and exactly what I talked about. Exactly what I mentioned in the current issue of U.S. News and World Report that I'm in is the part about taking some of your distributions early. Talk about Trump's tax plan, how that's going away in 3 years. If you are in a tax bracket, where you have earnings, but you're not high enough to be at the top of the tax bracket, you should probably pull some money out without going into another bracket. Here it is. But your 2022 tax information, which is what you're working on right now. Let's say you have earnings of, you're a married couple, and you have earnings of, let's say, $100,000. All right. Well, each of you get a deduction of 12.5, and it's like 14.5 if you're over 65. So that's 25,000. That knocks you into the 12% tax bracket. And that's without writing off your property taxes, your state taxes, any charitable deductions, etc. So you would be at a 12% tax bracket. Now, let's say your earnings are somewhere in that range. Let's say 70,000 AGI, and as opposed to 83,000. Perhaps you could take 13,000 out of your IRA, pay 12% tax, because that tax bracket probably isn't going to be around anymore, and then reduce your future income taxes when you're over 73, and let's say you're 63 and you do this for 10 years, you could pull out, $130,000 that you're not going to have to pay taxes on at a later time, convert that to a Roth IRA and never pay taxes on that money. I know that went fairly quickly and that's fairly complex, but the point is you should take advantage of a retirement income analysis to blunt the tax bite. And again, how do you do that? info@pfpinvest.com or 949-219-0692. Here's a question from Steve. Are you shielded from taxable dividend income from REITs? We're getting to that. Let me get that, because there's a thing on qualified versus non-qualified, or ordinary, and then qualified dividends. That's coming up. So just bear with me, Steve. I promise I'll get back to that answer. And if anyone has a question, put it in the Q&A or the chat, and I will come back to it. But anyways, so it's very important that you take advantage now of trying to figure out methods to pay less taxes. Now, if you're over 73, a lot of it's going to apply, just like Steve's question, it will apply. Where you put your money, qualified versus non-qualified dividends. So I'm back to this brochure. Are you paying too much in taxes in retirement, right? Do you see that? Okay, so let's go down to the next page. And again, it talks right here about how retirement income analysis can blunt your tax bite. I was wondering where I got those words. I guess I stole them from right there. So the point is that taxes are a necessary evil. And that's how we have our military and our roads and our mail service, et cetera. So we enjoy it, but we loathe paying more taxes. And so again, you want to control it. And so you want to preserve your assets during the distribution phase. And again, so you've got to know, when should you take income out of your account? Most people wait until they have to be taking money from the required minimum distribution, because they say, well, it's not required, I'll wait on that. And then they take Social Security early. maybe perhaps you should start taking money out of your IRA, 401k, 403b early and delay on taking your Social Security so it builds up to be a higher amount, because that's a 7% growth per year. And if you're over full retirement age, it's an 8% growth per year. Because if you, as you know, $500,000 in an IRA or $1 million in an IRA is not $1 million to you, because you got to pay taxes on that money. So some people, they're going to net out of the $1 million a lot more money in their pocket than others. Why? Because they're coming up with tax strategies of when and how to take the money and what to do with it once they do take the money. So again, this is what I was just talking about. An individual or a married couple, this is where I came up with that $89,450, but that's AGI, that's adjusted gross income, which you, at least if you take your standard deduction, you know, if you're over 65, it's about 14.5 per person. And if you're under 65, I think it's like 12.6 or even 13,000 per person. So you subtract that off to end up in these tax brackets, 10, 12, 22, you see those. So if you're somewhere in between, let's say you're at 22% tax bracket, let's put you at a 24% tax bracket. Your AGI is 190,000 as a couple, or maybe 95,000 to 182,000. So let's say you're at 110,000. Well, gosh, you can take $70,000 out of your IRA without going up in tax brackets. And if you think that you're going to be in a 22% tax bracket after 3 years, after the Tax and Job Act expires in 2025, I think you're dreaming. I think, you know, the government is going further and further into debt. We're not like, you know, broke. We're beyond bankrupt. It's just this, you know, belief that, you know, that the taxpayer is going to, you know, bail out the federal government. I mean, I've shown this before, but, you know, it says on our money, it says, in God we trust, right? It says it right there, in God we trust. No, we're trusting that these people, the capital, are going to get those people, like meaning us on this session, to pay our taxes. I mean, you know, I mean, I'm not being an atheist or using God's name in vain here, but, you know, we're depending on the taxpayer to pay their taxes. So if you could stay in a 22% tax bracket or a 24% tax bracket without jumping back up to the highest tax, to the 32% tax bracket, we're back on the screen, right? So you could go all the way up to 182. If you're a married couple, you can go all the way to 364,000 AGI before you jump from less than 25% taxes to a third in taxes. And so to not use that wiggle room in there, and really to go from 22 to 24, it's not much. It's only on the amount over. It doesn't go back to $1. Now suddenly you jump from 22 to 24%. It's only on, let's say you go 10,000 over. Well, then you have 10,000 at 24, and you'll have the other 95,000 at 22% tax bracket, because it's a graduated system. So it's really important to know that, you know, your retirement income, while it can come in a lot of sources, taxable and non-taxable, you know, it really just depends on the source. And that's the 3 types of taxes that I'm talking about. Is that there's taxed always. It's like your brokerage account, your savings account, your CDs. You pay taxes every single year on that money, on the interest, or on the gains and losses if it's a brokerage account. But on an IRA or IRA, 401k, 403b, all that money, that's tax deferred. Deferred until when? Well, it's deferred until you take the money out. I mean, this is, you know, again, taxable qualified accounts, 401s, 403s, simple IRAs, SEP IRAs, profit sharing plans. You know, these monies are all designed to be after 59 and a half. There's a 10% penalty if you take it early, but it's taxable always anytime you take it out, because the money has been grown tax deferred, meaning you got to pay it in the future. Okay, so when in the future does that happen? Well, and I'm going to come back to the Social Security, but let me go back to this page here, page 5, I guess, right here, is taxed always, tax deferred. And then the thing about that is that tax deferred until when? I mean, this is income tax free to you, but taxable to your estate. Well, things like annuities, that will go tax deferred like an IRA, you know, but the IRA can continue after death for 10 years to continue to be tax deferred. But with an annuity, that is payable upon death. 529 plans, if it's to you, then you pay that upon death. An income tax free to you and to your estate are things like Roth IRAs, certain types of insurance, tax-free municipal bonds. Those things are never taxed. So the three types of taxes: tax always, tax deferred, and never taxed. Three types of taxes. I had a slide, didn't put it in, don't know why, probably should have, but there we go. Always, later, deferred, and some is deferred till your death, and some is deferred beyond your death for 10 more years, and some is never taxed. How do you ensure Medicare is not taxed? Well, again, those are income thresholds. So let me go back to it. Just like your Social Security has income thresholds. Here we go. We should be back on the slide. I don't want to ruin it for everybody, but here we go. Social Security, right there. So your Social Security, so Medicare follows this as well. If you have if you file individually and your income's between 25 and 34,000, up to 50% of your Social Security income is going to go on your 1040 and be taxed at whatever tax rate you end up on. Okay. If you're below 25,000 as an individual, well then, then you're okay. None of your Social Security will be taxed and none of your Medicare will be taxed. Now, if you're an individual making more than 34,000, and that includes, qualified retirement accounts, that you draw from your job, and actually half your Social Security income counts on that level of this income threshold. Okay. So 50% of your Social Security income, any IRA withdrawals, any job, that's these thresholds. So more than 34,000 in income, 85% of your Social Security, you have to pay income taxes on it. And the same with Medicare. If you're married, and again, this is combined income, so your household combined income is between 32 and 44,000, then you're paying up to 50%. It's a graduated that at 44,000 is 50%. And then, but it starts less than that at 32,000. And again, anything less than 32,000, if you're married, filing jointly, and your combined income is less than 32, then you're not paying any taxes on your Social Security income. And again, combined income is adjusted for gross income and non-taxable income plus 1/2 of your Social Security benefit. Now, if you're making more than 44,000, which probably most people on this call are, then up to 85% of your Social Security and your Medicare are subject to tax. So how do you do that? Well, you got to put more money in tax never, and by converting, your IRAs into Roth IRAs. And now that I usually tell you to do at the end of the year. We're going to cover that later on extensively in one of these webinars. But because they only allow you to change it, you don't allow it to change it. You used to be able to recharacterize, that's the word, recharacterize your Roth distribution, or your distribution from your IRA to a Roth. They don't let you do that anymore. So I suggest everyone meets or has some idea where they are, come like September, October, November, and understand what tax brackets they're going to be in, and then make that change based on knowing, these tax brackets, how much to get to without going over and putting yourself in a higher tax bracket is what you want to do. Excuse me, I had to have a little bit of water there. Okay, so here we go. Let me see, how do you ensure Medicare is not taxed? We've got that. There's another question in the Q&A. Includes pension income. Yes, Jim, your pension income counts. So if you get pension income, that counts towards income that's going to be taxed. So yes, that does count. And then your Social Security, half your Social Security counts as well on those brackets. So once again, it's really important to understand that there's qualified money, which is tax deferred, Social Security money, which can be taxable, and then annuities, that grows tax deferred as well. So if you have money in an annuity, you can take that money and reduce your tax liability and reduce these numbers down by having the money in an annuity. Now, if you draw money out of the annuity to live off of, well, then yeah, that counts as taxable income, because an annuity is a supplemental retirement account. It supplements your IRA. It's called an SRA, supplemental retirement account. So your IRA is money you can live off of. Now, if you don't need the income, then an annuity is a great way of putting that money out there and not having to pay current income taxes. Now, again, upon death, there it works. So non-taxable income, there's Roth IRA, and then municipal bonds. So let me get to municipal bonds here real quick. Let me jump to that, because where are we at on the world of income? Here, I had it on the screen. Good job. Let me just find it. That's not it. Perfect. Here it is. Yeah, no, neither am I. Hang on for a minute. That's not good. Here we go. That's not working. It's under the Google Chrome. Hold control. You see it. I mean, how many years have we been doing this? Still don't know. That's all right. I think I'm going to give up on that one. So here's what we're going to do is, I'm going to look at it and we're going to go with what I see. And that's this. You know what? I think I can do it. Let me just try one more time. Screen share, new share. There we go. Check that out. There's hope for me yet. Okay. So tax-free municipal bonds. So here's a Riverside County. Again, buy them in the state you live in. It's better. It's an A-rated bond, general purpose. So Riverside County, I think, is the biggest county in the United States in terms of square miles. 3.25 up here in the upper right, 5/1/2034. So that's, what is that? 11 years. And if you look, you could buy it at a discount. Par is 100. So you're buying it for 96.5 cents per dollar. And you can get 3.515 yield to maturity or yield to worst. So that money would grow tax-free, and it's backed by the taxpayers of Riverside County. Now, if you're in a, let's say, 24% state or federal bracket, and let's add 5% in for state, so you're like basically a 30% tax bracket, you take the 3.1515 and divide that by 1 minus your tax bracket, which is 7, and that's a 5% yield would be a taxable equivalent yield, 5%. Well, that seems pretty good. But now, if you look at that, you're tying your money up for 10 years. If you say, well, gosh, what if, hang on, no, I didn't want that. All right, it's not going to let me do it. Here we go. Treasury bonds. You're seeing this, I hope, me finding these treasuries. If you go out, let's just say 6 months to, let's say, here's July, here's September. There we go. There's a treasury bond, 4.5% with no state tax. So 4.57, and you take it, 0.95 divided, that's 4.8 for tying your money up for 6 months. So would you rather tie your money up for 11 years and get an equivalent that you could use with a U.S. Treasury and have, instead of Riverside, have the whole United States backing you? So, that's why people aren't really buying those longer term bonds, because we have an inverted yield curve and interest rates are better short term right now than long term. Now, that's one of the problems we have, with the markets and the economy and things like that. People are really concerned. Here's another question. Some Google Pixel person wants to know, how will you be recording and replaying the update? Yeah, you just, again, call the 949-219-0692 or email us at info@PFP-Invest. PFP is for Pacific Financial Planners, and then the word invest.com, and we'll send you an audio recording of this. But anyways, the point is, with the inverted yield curve, when interest rates are higher shorter term than longer term, that's a problem, because banks don't want to lend money long term. Why? Because they have to pay their depositors with the higher short-term rates And when they lend long-term at the lower rates, they end up like Silicon Valley Bank or First Republic. And that's exactly what those idiots did, is they were tying their money up long-term versus reinvesting short-term, making less of a margin, but making sure they had the liquidity. So when they had to run on the bank and they had to sell these long-term investments, they took losses on it. And therefore, even though the investments were guaranteed, a lot of people are falsely claiming, oh, you know, the Dodd-Frank was violated and it was repeal of laws. It had nothing to do with it. It had bad banking practices that had everything to do with it. And so, you know, I'm going to actually show that since we're on the webinar. It's the first time I could actually do that on this whole deal. So here it is right here. So this is time going out. Okay, so here's 10 years. Okay, it says Tim, but it's really time. All right. And here is interest rate. Okay, so the Fed just raised the rate to 4.75 to 5% on the overnight lending rate. And the 3-month rate is something like, you know, I just showed you the 6-month rate that you can get 4.5%. Okay, 4.5 here. So this is 4 3/4 overnight, 4.5 for 6 months, and you're like 3.3 for 10 years. Okay, 3.3 for 10 years. So the bankers borrow here, and these guys were investing here. And as interest rates go up, which there was a rate hike this week, the price of bonds goes down and you own the price. So they've been losing money by selling these bonds. Silicon Valley Bank had to sell these bonds at a loss because their investors were getting this. What they should have did is they should have put money here. So they didn't ladder. They didn't go out, you know, 1 week, 2 weeks, 3 weeks, 4 weeks with billions of dollars. They went like this. They put zero money here and they waited for 10 years and they invested 10 years to get a higher yield back a couple of years ago when all that COVID money came in. So when they had to sell it, they sold it at a big loss because they were averaging only 1.25. And when interest rates went up from 1.25 on the 10-year to 3.3 today, interest rates went up. The price they had to sell it went down because they didn't have liquidity. They should have barbelled it. They could have had half their money in less than 60-day paper, like a money market, and the other half the money out here. And as 20% of people decided to liquidate, they would have had 50% of their cash here. They would have been able to meet their needs, and those 20% would have calmed down and nobody would have had to run on the bank. So it was just stupid banking. I hope that explained it. I don't know if it did, but that is actually how it works. All right. So where you put your money matters. I've got this this screen that I could send you guys, and I mean a brochure that I could send you guys, and I really believe that this would be helpful to everybody out there that's watching this today. Here it is. Do you see that? Hang on. There we go. Do you see that right there? There you go. So the tax laws are changing all the time. And, you know, we're going to for sure change in 2026. We might change sooner. But with the House now run by Republicans and the Senate and the presidential run by Democrats, I don't think either side has veto, to overcome something so that Republicans can't put something on there to raise taxes. But if the Democrats do put something on there to raise taxes, like Biden wants to throw his, you know, certain things, the Republicans, I'm not saying they will or won't, I have no idea, but they can overcome that. They don't have to vote for it. And then there's no veto power. So I don't know if a whole lot's going to get done in the next 2 years when it comes to taxes. So like I said, taxed always, tax deferred, you can pass that tax deferral on to your children with IRAs, and then income tax free to you, but taxable to your state, things like annuities, those type of things. You will never have to pay taxes. Your estate will when you pass, but it gets it out of your hair. And then income tax free forever. SEP, Roth IRAs, tax-free municipal bonds, they're always free of taxes. If you're not diversified with your financial advisor in these three types of taxes, then you're truly not diversified. You need to talk to your advisor and get tax diversified. A lot of people talk about, oh, I own small company stocks and large company stocks, et cetera, but that's not diversification enough. If you want this brochure, be happy to hand it to you, or email it to you, or mail it to you. Consider a Roth IRA. And again, it's $7,500 this year, $6,500, and if you're over 50, it's $7,500 because you've got 1,000 catch up. And then you could give away money, $17,000 to anybody you want, your children, grandchildren. If you're married, you can give 34,000 away. If they're married, you can give each of them 17,000. You can give it to your neighbor, friends, whoever you want. Nancy would be happy to give you her address. So bottom line is that is another way to reduce your taxes, is by giving money away. Now, some of you, are worried about having enough money for yourselves, then it's not such a good idea. But gifting is a good idea for a lot of people I know on this call. All right. So we covered that. I'd be happy to send it to you, should you have any questions. So going through that, we've covered the tax planning versus tax preparation, where you put your money, brochures, types of taxes. Now we're going to get to the question that Steve had. Are you shielded from taxable dividend income from REITs and a 401k? Well, hold it, wait a minute. Yeah, from REITs and a 401k, yeah, as long as it's not a partnership. I had to read your question differently. Now it's in a 401k, so it's in a tax deferred account. Now, if you get a K1 on the REIT, it depends on how it's structured. Some are structured as 1099 income, and you'll know because you'll see it on your 1099. Or some of them, they send you a K1, which they have until, I think, March 31st to get these K1s out. Then there's a chance you pay taxes on your REIT in your 401k, but you make sure your tax advisor understands that. I am not a tax preparer, but my understanding is, unless you're generating more than $1,000 worth of income to you from K1 income, then you have to have it. You should put it with your tax returns, but it's not reportable as dividend income. Okay, so that's a tougher question. I could call my tax advisor. This is what I do sometimes. He's a little busy right now, but I can help you get that answer. But there are people in a 401k IRA that do pay some taxes from the K1 from generally their partnership. So if your REIT is structured as a partnership, then it's possible. But there are publicly traded REITs that are not partnerships. There's hundreds of them. So anyone buying a partnership REIT, as soon as you can get out of that thing, get out of it, and you can replicate it. I love REITs, real estate investment trust. That's what a REIT is, a real estate investment trust. So the way those are structured is, if you buy like there's REITs that are senior housing. I think those are great, right? As we know, baby boomers are getting older. That's the group that born in 1946 to 1964. So the front end of the baby boomers are turning what? They're turning 76 this year. Well, a lot of 76, maybe it's 77 this year. A lot of 77-year-olds, are just now starting to have problems. Maybe it's 2-3% of them. Now, again, some have problems in their 60s, etc. But when you hit 80, now you're probably up to 10%. When you hit 85, you're more like 25% need some sort of long-term care help. And remember, on the baby boomers, it's back end loaded. There's more baby boomers on the second half of the baby boomers, 1946 birth to 1964, than on the front half. But as they age, it's just science. Bodies break down and they need help. There's not enough children. They're working. They don't care, whatever it is. Spouses eventually, they try to help each other out. One passes and you end up, institutionalized. Nobody volunteers like, hey, I want to really go to this long-term care facility. How soon can I get in? But it does happen. It's a fact of life. So there's senior housing REITs, real estate investment trusts, are what we're talking about. Those collect rent. 90% of the rent from those REITs pass through to you in the form of a dividend as the investor. If your real estate investment structure is structured as a partnership, then you get a K1, and it's possible even in your 401k, you might have to pay taxable dividend. It depends on how much of your income is derived from K1 income. If some people, they'll have to pay, and other people in the same REIT, they won't have to pay. But if you buy a REIT that's listed on the exchange, that's 1099 income, then it'll never count against your 401k or IRA. So that's a way to get around that, Steve. Hopefully I answered your question. If you have more questions, call the office 949-219-0692. But we were on REITs for a second there, and I just want to finish that, is that the REIT income comes to you because it's a pass-through. They're running the real estate investment trust. They're paying their property taxes and the maintenance and all the employees with 10% of the revenue. And then the other money flows through to you. So you can get some of these things 5, 6, 7, 8, even 9% dividend stream income. And is it good? Yeah. Is it based on the stock market? No, it's based on real estate. And so to be diversified, you know, to have that in your portfolio of investments passively through your accounts makes sense for a lot of people. And as the demand goes up, because the baby boomers is back and loaded, as they start getting more and more need for senior housing, with the largest retirement group ever in history. I mean, for those people born before 1946, for every 2 seniors born before 1946, there's 3 boomers coming behind them. Now, nothing's going to change from when these 2 people turn to 85, probably 25%. So out of every 4, one's going to end up in a nursing home, some sort of a facility. Well, if there's 3 coming behind them, that means 50% more people needing long-term care. Does that make sense? Makes a tremendous amount of sense. So REITs are pretty good. And yes, Deanne, you can have a REIT in your IRA, especially the publicly traded ones. And I know that I look for those and put those in people's accounts. It's just the market lately has been, you know, still bad. That's kind of one of the problems. I mean, you know, here we go. Let's go over to, oh goodness, I got to pull that up again. Hold on, now I at least know how to do it. Let's see here. Here's the market screen. Goodness, it didn't work again. Let me try it one more time. New share. There we go. So here is the S&P 500 right here, and you can see that we still have this downturn that started at the end of 2021, and it's been going down. I mean, you don't need to be a rocket scientist to see that the market's still trending in this downward direction. Now, am I hopeful? Yeah, I'm hopeful that this low here that was set in June, and then we had a lower low in October, and then we had a little bit of a better low in December. And now here we are, we tested that low recently without going below December's low. Yeah, they're giving me some optimism that perhaps we have a new uptrend going, but it's still too early to tell given the predominant downtrend that's been in place and some of the news like banks going under, et cetera. But with all the banks going under, look at this. We stayed higher here on this right-hand side lately in the last several weeks. This includes all these bank bankruptcies and all the higher interest rates, et cetera, than we were in December and in October. So that's a good sign. And then that would allow us to be able to maybe get more back into the market. I'm optimistic on it. Here's a REIT, for example, one called Public Storage. You might have seen their signs all over the world. Public Storage is a REIT, but look, same thing. At least the lows seem to be holding, but we have a downtrend across the highs. Here's one of the ones that I was talking about, REIT that invests in healthcare and senior housing facilities. Same thing, kind of trending down. It looked like it was starting to turn around. It got to its 200-day, and now it's going back down again. And when you look at the dividend, 3.7%, that's not bad. Here's another one of these long-term care properties. Look at this dividend yield, 7%, only a 13 PE. So this is a really good value in my opinion, but look what it's been doing. It's been trending down, and more recently trending down even faster. So at some point in time, this is going to be a great buy. I keep my eyes on this stuff. This is what I do every day. I'm looking at this thing. I'm looking for the trend to change. But as you can see, 3208 is where it closed today. And this low was back in April. We closed at the low for the last, more than a year. So you don't want to buy that because it's going down, because it could go down instead of 32, 28 or 25. But at some point in time, as long as they have the ability to pay the dividend. Well, how do I know that? You see this 7% dividend? That's off today's price of $32, okay, $32. So 7% of 30 is $2.10. So this probably pays about a $2.40, $2.50 dividend, which I have. I can look up to see exactly what it is, but it's somewhere in the $2 range. See this cash flow of $3.45? Are you guys seeing this? See that 345? That's the excess cash that they're kicking off from collecting the rent from these long-term care properties. So yeah, we could buy that, but if you're losing principal, I could put the money in a safe money market or a T-bill while we wait for this thing to turn around. So we're not gonna, have this money at risk right now, but at some point in time, as long as this cash flow persists, this will be one of those good long-term care deals that I'm talking about. Hopefully that makes sense. And again, it goes back to Steve's question. And again, which one REIT? There's a lot of REITs. And again, I didn't recommend any of them because they were all going down, but REITs make sense. When the time comes, when these turn, we'll have some market updates because, as you know, I usually talk about the market here at the end. So we're getting kind of tight on time. Let's talk about qualified dividends now. I think that answered all the questions. Lagging indicators. I don't know, Jim, what you mean. I know there's leading and lagging indicators. The leading indicator is the inverted yield curve. That says we're going to have a recession. Bank failures also is a leading indicator that things aren't as good as they seem. That's a leading indicator. I don't know about lagging indicators, but that means they're after the fact. Maybe I said something that you think is a lagging indicator. It's possible. But qualified dividends, an ordinary dividend that's going to report it to the IRS as a capital gain rather than income. Okay, so a qualified dividend meets criteria to be taxed at a capital gain. What do I mean by that? Well, capital gain tax is different. It's not the same. If you're in an income bracket where you're earning, I believe it's 45,000. Hang on for a minute. Let me get this because I think it's in this other one here. Goodness. Yeah, watch this. It's going to be in my trash. You can see that now. Perfect. So if your income is $45,000 or below, you're in a situation where your capital gains tax is zero. If you're making more than 45,000, then of course you're paying 15%. So if you're in a 20%, 22% tax bracket, then you want to be, having your money be qualified dividends. So to be qualified, you must have held that investment for longer than 60 days prior to the dividend. Now, if you hold it longer than that, then and again, it was 44,625. That's where you're paying zero if you're single. If you're married, filing jointly, if you're in a 10% federal tax bracket, a 12% federal tax bracket, your tax rate on capital gains is zero. A lot of people don't realize that it never goes 20%. It doesn't reach 20% unless you're making more than 492,000 as a single person and more than 553,000 as a married couple. Otherwise, it's at 15%, which is lower than most people's taxable income, because if your taxable income is in the 0 to 12% tax bracket, that means your capital gains tax is zero. So a qualified dividend again, is a dividend that you held for more than 60 days on any type of stock that's publicly traded or listed, and you got to hold it 61 days before the ex-dividend date. So some people try to buy the dividend like a week before, and then they sell it. Well, then it's going to be taxed as regular dividends, and it's ordinary income. So if you're in a 24% tax bracket, you're going to pay 24% plus your state taxes on top of it. So that is really important. It's the ex-dividend date, 61 days before it. Now, what I try to do for my clients is, we were talking about this long-term care property REIT, is once we buy in it, our ideal hold time is a year, 2 years, 4 years. We'd love to hold it, but if the price starts going against us, we sell those. But if you hold that, something that's paying you 7% dividend, and you're holding it for longer than a year, longer than the 61 days prior to the ex-dividend date, all those dividends will be in the lower tax bracket as a capital gain. So dividends must be paid by a U.S. company, not or a qualified foreign company like an ADR. The dividends, not listed with the IRS are not qualified. And again, you got to have that holding period. That's the whole deal. So when you see on your 1040 or on your 1099, they'll show you qualified versus not qualified. Sometimes you get an updated 1099. You got your 1099, you do your taxes, and then suddenly April 5th, they send you a notice, hey, look, here's your updated 1099. It usually is only that they figured out that either some dividend should have been qualified, meaning taxed at the lower rate, or some money is not qualified and should have been taxed at the higher rate, and you have to go change your reporting. Is what you're supposed to do is file an updated tax return. That's why it doesn't really pay to do your taxes early, because they have so much time to get you the K1s if you get that kind of income, and they have so much time. That's really, early March or late March and early April is when that happens. So again, how do you know if the dividends are qualified or not qualified? Well, you could ask your advisor, is this dividend qualified or not qualified? Or you're certainly going to see it on your 1099. But again, the bottom line is if you could go from, let's say, Steve getting K1s on his 401k that he might have to pay taxes on, to having everything be qualified dividends. Now, if it's in a 401k, he's not paying taxes on that. But that's how you save money on taxes. Is you're going from higher taxed dividends and income to lower taxed. And again, same thing I talked before, banks, bonds, and insurance companies. Well, these banks is taxed always. Bonds, if you're buying like treasury bonds, they're tax free from state taxes, but federally taxed. Then if you buy municipal bonds, they're free from all taxes, state and federal and local taxes. Now, with an annuity, you can put money in there and get income. We have annuities right now that are between 3 and 5 years paying 5% or more in terms of the rate. I mean, that's really, really good. I mean, these are good rates. Now, these rates are probably dropping because of the Silicon Valley Bank thing. I'm starting to see rates go down again on the longer end of the market, not the short end. Fed's raising money on the overnight lending rate, not the longer end. And so, some of those make some sense. And again, with the markets down, you could buy in these index annuities, and they make great sense to buy in today because the market's low and you're buying in at the low levels and you have a guarantee to not lose any money. The money that you do make is tax deferred until when? Well, if you don't draw it off until your death. That's deferred pretty good, where it doesn't count against your Social Security income, your Medicare income, or any of the other incomes that you might have. So that's really, really good. And then, like I said, is that you could look for qualified dividends, and then even when you sell stock, same thing as if you held it longer than a year, then it works out to be qualified income as well, which means it's taxed at the capital gains tax rate if you held it for longer than a year, which is 0 to 15% for most everybody on here. If you're making more than $492 as an individual or $563 as a married couple, make sure you call my number right after this event, 949-219-0692, because we got to talk. But in the end, taxes are important. You want to know, to do some tax planning to reduce taxes. You got to look at the 3 types of taxes. Make sure you're participating in all different types. That's why a Roth IRA is important. How to convert to a Roth IRA is important. We talked a little bit about that. I'll have more on that on another segment later in the year. We talked about qualified, non-qualified accounts and dividends. We talked about investing for tax advantage income. Again, state tax bonds, state tax-free bonds are treasury bonds. Municipal bonds are tax-free all the way around, and annuities are tax deferred. And those are all investments that are guaranteed by the issuer. And insurers are reinsured by other insurance companies, and then they're backed by the state that insurance, that annuity was issued in. And so, like if you're in California, you had an annuity issued by the state of California. I mean, we're like the fifth largest, we'd be the fifth largest country in the world. I mean, we've got a huge tax base here. That money is safe. Talked about how a retirement income analysis can blunt your tax bite and why you should call or send us an email. I also told you that you can get that handout. We'd be happy to send it to you, email or regular mail, 949-219-0692. And then, I just want to talk again a little bit about the markets and volatility. Again, the number one mistake people make is underestimating volatility on a portfolio throughout retirement. And that's because when you're investing for a purpose, right? So when you're young, when you're looking for total return, what you're really looking for is growth. But when you're older and you give up that paycheck, you're really investing for income. Now you can get growth and income for multiple sources. It doesn't matter. Stocks, I was just talking about how these, some stocks pay big dividends. All right. It's really important. But the difference is with the growth, it's unknown. You don't know if you're going to get growth. I mean, the idea is you want to buy, something at $10 a share and you're hoping it goes to $15 a share. Well, that's great. But it could also go to $5 a share and the G can become an L. So it's an unknown way to invest. Now, when you're young, you're okay because you could dollar cost average. You can buy more and wait it out, and you're buying as the market goes down, hoping that when it goes up, you're buying more and more shares at this lower level. But when you're older, like this is the market between 2000 and then 2007 and then 2013. So, some people don't have 13 years to wait to break even. So investing for growth can be tough. And this 13-year period of time was recent, but it goes back over time. Well, with dividends, you get more surety. Okay, there's more surety. You got 99% surety if someone's doing these cash flow analysis, like I was showing you, that they're going to pay either a percentage of interest, like a bond, or some dividend income. Okay, and they can cut the dividend, but if you're doing the right analysis, you got 99% surety that you're going to get some return, which is what you invest for, by going to the I once you retire. I mean, when you're younger, you've got time to ride this out, but when you're older and wiser and don't have enough time, do you want to invest for surety, or do you want to invest with the unknown? And that's why I keep saying that there's a life stage of investing that you want to switch from the accumulation stage, when you're accumulating money, to the distribution phase and use income and then tax advantage income, etc. It depends on how your tax brackets are. We can look at, again, banks, bonds, and insurance companies. So at your age, would you rather have your retirement be based on the known or the unknown? And that's kind of your idea. And I know I've given this before, but I'm going to give this here as we wrap up, is your retirement is like owning a chicken farm. Okay, so this is supposed to be a chicken here. Okay, so I don't know how good I can draw, but there you go. That's a chicken. All right. So there you go. These are it's web feed or whatever the chicken has. I actually did go to a farm growing up. My mom came from a farm, and a chicken lays a certain amount of eggs. I don't know how many eggs you'll get per chicken, but let's just go 4. So if you've got a chicken farm with a lot of chickens, this is your retirement assets. And then the chickens produce eggs. What do you want to live off of? Do you want to eat the chickens? Because the more chickens you eat, the less eggs you're going to have. Or do you want to eat the eggs? See, right now, if you have $1 million, let's just say, and that $1 million can go in and produce 5% income. That's $50,000 a year without touching your principal. Now, if you invested in the market last year, let's say January 1st of 21, that $1 million is now worth 750,000. So to get back to $1 million, even though you lost 25%, which is about the average of what most investors lost last year in the market, you now need a 33% return. You need this to go up by 250,000, which is only on your 750. You don't have $1 million to make this 250 anymore. You got to make this 250 off the 750. But if you're living off of income to pay your rent and your mortgage or whatever it is, you buy your travel, now you need 300,000 to try to get back. So once again, our style of investing for income, is really important. Most advisors have no idea how to invest for the I. What they invest for is the group G. And a lot of investors, a lot of people, probably you guys listening today, have stuck with the 401k. Steve, I'm talking to you, because a 401k is designed for younger working people to grow their money. That's what it is. Most of the choices in there are growth investments. They have very, 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 very few investments are for income in your 401k, but you're just betting on the growth. And that's what brought you to the dance. It got you to retire, to retirement age. So you say, well, this got me here. I'm going to stick with the strategy. But there's got to be a mind shift towards a more conservative strategy, a dividend strategy. Same thing. When the market goes down, they call them value stocks. The reason they're called value is they're more valuable in a down market because they're still paying you. First requirement for me when I invest for our income methods is to demand income, not some promise of the future that I'll be able to sell it to a greater fool at a higher price. But if I get income, cash coming in now, kind of like when I was working and I got paid every 2 weeks. Now me, I'm still working, but like you get paid, you were paid within weeks. Well, you want that from your investments as well. And that's what I think is important. It's really important to have that strategy in place as you go forward. And, with that, it's been an hour. I appreciate everyone being on here. I want to take any questions that people have. I haven't seen anything come up. You can go down to the chat or the Q&A, and I'll take any questions that you might have. This market is still tenuous. It could be turning around. I also want to tell you that our April webinar is April 25th, and it's on the rising cost of retirement, 7 mistakes to avoid. Okay, so the rising cost of retirement, 7 mistakes to avoid. You've got it's April 25th. Put it on your calendar. 3 to 4. We run a little long with anyone having any questions. Again, if you have a question now, put it in there. I did cover everything on our that we put down, but the last one is always any questions about money and investing. So I'm waiting here a couple minutes, but it's important that you have the understanding of tax planning to reduce your taxes. If you do that, you have more money to yourself, less money to the IRS. I'm not saying cheat on your taxes. I'm saying pay them their fair share, but not a penny more. Where you put your money matters. Having the 3 types of taxes represented. I talked about qualified versus non-qualified accounts and dividends, how that helps you, especially if you're in a lower tax bracket, 0 to 12% tax bracket. You're paying 0 capital gains. You're paying 0 taxes on qualified dividends. Again, tax advantage. We talked about, how treasury bonds, municipal bonds, and annuities, insurance companies can offer better ways to invest to reduce Social Security taxes, etc. And then again, why it's important to do a retirement analysis for many of you. Gotta shut that off. And again, any other questions? Be happy to take right now. Thank you, Karen. Appreciate the comments. But come back next month. Tell your friends. It's free to talk to me. I talk to people 3 ways, either in person, love that the best. We could do it on Zoom, just like right now. We all know how to do that. And then I'll allow your audio where everybody will hear me. And then we can also do it via phone. All right, any questions? Free, no obligation. And a lot of you are my clients. Be happy to review your portfolios with you, make sure you understand what we're doing and why. Otherwise, that's it. Thank you very much. We'll see you next month. Give me a call, 949-219-0692 if you have any questions. Otherwise, take care, everybody. We'll see you.